Well, we just got done recording with Octe. It's a fun conversation. It's they got some interesting products.
Yeah, yeah. Obviously, just how the company started and kind of what they're doing with leverage products as well as income-based products. I mean, you mentioned income off gold, which is interesting, right? So we
Yeah,
kind of talk about the calls and puts mechanism and what they're creating for products too. So that was very interesting.
yeah, yeah. We definitely we get into the leverage shares, like how they're uh how these leverage shares work. So like we've seen over the last couple of years, there's a lot of like products like 2x S&P 500, 3x QQQ. Also, you can buy like the short versions of these ETFs, which is really cool. Yeah, it's I think it's a really cool concept that's obviously the market really likes. These products have taken off in the last couple of months, last couple
Yeah,
of
well,
years.
especially to keep it simple for the investor, where they don't have to go out and have a trading account, a margin account, and just pick a solution here. It makes a lot of sense.
Yeah, and there's obviously for those listening, there's definitely an educational aspect to these products. Like I know I was right out of college, like trading something like 3x leverage gold, things like that. There's price decay. So it's,
Yeah.
or like, I don't know, price decay is the wrong word, but you're not meant to hold these products for long periods of time. They're great for day traders. If you have a quick swing trade, a couple of days here and there.
On
But
the leverage side. Yeah.
on the leverage side, yeah, I love the concept though.
Yeah, absolutely. Very, very fascinating. Obviously, with Octay being in Europe, kind of just the element of distribution, as it looked like, and that was also an interesting conversation as well.
Yeah. Well, cool. Let's get into it. Thanks for tuning in. Thank you for tuning into the All Funds Network. My name is Mike Schroer. Today I'm here with my co-host Skyler Steinke, and we are joined by Octay Kavrak. Octay, Octay is the head of communication and strategy at Leverage Shares. Octay, really excited to have you on the show today, man.
Thank you so much, Mike and Skyler. Great to be
Absolutely.
here.
Well, Octay, let's get into Leverage Shares. So, just start off. I think the name says it all, but just tell us what you guys are working on at Leverage Shares.
Exactly. So, as the name implies, we're best known for what are called leveraged ETFs. We actually started a concept that I think is one of the fastest growing corners of the ETF market today, which is single stock ETFs. So, when you think about double leverage Tesla or triple leverage Nvidia, that kind of concept didn't exist when we launched Leverage Shares, which was back in 2017. So you had things like leverage Nasdaq, where you could get daily 2 or 3 times, exposure to broad-based indices or commodities or things like that. But we were like, why don't we take that same concept and apply it to individual stocks? Because here in Europe, you actually have a lot of sort of competing structures. So there are things called CFDs. Obviously, options are also a thing, but they're not as big as they are in the US. You can trade, what are called certificates. These are like very popular in places like Germany, but those all come with their own fair share of headaches. So we're like, everybody loves ETFs and ETPs. They love that convenience. Everybody wants to stick with the broker that they're already using instead of like making an account with some, some,
Yeah.
yeah, some kind of shady platform or whatever. So yeah, I mean that's where the company started. It was back in 2017 with 2x single stocks, and since then we've just been listening a lot to the investor feedback over the years, because honestly the uptake was quite slow at the beginning. It was a new concept. People didn't necessarily know why they should trade these products, how they differed from like just trading the stock
Yeah.
outright or trading on margin and things like that. But I think right around COVID or slightly after COVID, something really clicked, because all of a sudden you had a lot of DIY investors that were so interested in, opening up an investment, portfolio, trying to build their portfolio for the long term, or just trying to do day trading or anything
Yeah.
like that. So that's when they started paying attention to like all these kind of different instruments on the market, and that's when our products really took off. So we went from like a very niche category back, about what is it, 8 years ago now, to for the last 3 years we've had the single most traded ETF ETP on the London Stock Exchange, and that's more than any product from iShares or any product from Vanguard. So it's been absolutely
Yeah,
insane.
that's really cool. Well, I mean, that's a good thought process, maybe to kind of start into like, what is the difference, right, from an ETP? These are physically backed, right? Maybe give us a kind of synopsis of how they're different in the marketplace from what you guys have created.
Sure. So when you hear the term ETP, it's not a concept that you hear very often, especially
Yeah.
stateside. But here in Europe, it's used quite often because ETP is basically the umbrella term that encompasses ETF, ETC, and ETN. So here it's very strict in terms of what you're holding in terms of the underlyings to be able to be classified as an ETF. Because if you don't have that certain level of diversification, you can't call your product a fund. So essentially, it falls into the category of ETC or ETN. So ETC applies to only commodities. So if you're doing gold, that can be an ETC. But anything outside of that, just like the landscape, I guess, wasn't expecting these kind of products to come to market. So the only remaining structure that this can go inside of is ETN. So when people think about ETNs, they think about all these companies that went to zero, especially during like the banking crisis and things like that in the US. But here in Europe, you can have physically backed ETNs. So even though it's a note structure, you have those, you have that same stability built in, just like you would have with an ETF in the US. So you have, collateral that's with a trustee that makes sure that if anything were to happen with the company, all of that could be sort of liquidated so investors get their money back. So there's not that risk of, let's say, a company like Leverage Shares going under and investors, being, losing a lot of money. It's just not possible. So when you think about ETP or when you hear the term ETP in Europe, that usually applies to products like crypto, especially if you're talking about single crypto exposures, single stock exposures, and basically anything that's not diversified. That's how we use the term here in Europe.
Great.
Yeah, got it. And we're using a lot of abbreviations for those listening. ETF, electronically traded fund, ETP, electronically traded
Exchange traded
products,
product.
right?
Exchange
Exchange
trade.
traded products.
Yeah.
And then ETN is, I assume, notes.
Note exactly. Yeah.
Okay,
hmm
cool. Yeah, it's the single stock is a very novel idea. And they've obviously like taken off. Was there any like regulatory challenges as you guys, got this up and running?
So yes and no, because I know Europe has this. It's got this reputation of being very conservative, right? That people don't like to invest in risky stuff and things like that. But if you were to look in certain markets, you would be very surprised how risky some types of products exist. So if you look at places like Germany and Sweden, forget 3x, you can trade probably 13x daily levered. Like individual stock like Tesla, like it's
Wow.
crazy. And these kind of products they're not necessarily they don't come with the same transparency that you get with an ETF. So oftentimes they're listed by or they're issued by a broker or some other kind of party that that might not have all of those the safety measures that you get with an ETF. So there's historically been a lot of products that offer not just a lot of leverage but these structured note kind of payouts. So if you're looking for things like you kind of get some buffer on the downside but you don't get the full participation on the upside, or all kinds of sort of these like quirky payout kind of structures, those kind of products have been quite popular here for a long time. The thing is, it's only been with the big banks. So if you didn't have an account and you didn't work with a private banker, and if you didn't have a lot of money to invest, it was very, I would say, difficult to get access to these kind of strategies. So it's the same story that's been in the US, right? The entire idea of an ETF is to bring convenience to the market. So that's
Yeah.
essentially what we started doing with these products. We thought, how can we cut out a niche for ourselves? That was a single stock product. And since then, obviously, we've done a lot more things, but that's essentially how we made a name for ourselves. And the latest venture now is going into what are called options income ETFs, which are these ETFs that sell options in the background, and in return, investors that buy these products get this monthly dividend or monthly yield. So that's like the newest concept that we launched and introduced in Europe.
With talk to us a little bit about the who do you guys see as the main audience for these products? I assume as you kind of alluded to, like since COVID, there's been a lot of like retail investors in the market.
Yeah,
A lot of them have been a lot more active.
yeah.
Is that kind of the main audience for these products, or give us the full kind of the scope?
Yeah, I mean, obviously there is a mix of some institutional investors, and there are a few professional investors that, for their own sort of like prop trading reasons, they buy these products. But I would say the overwhelming portion of investors in these products are the DIY or the informed individual investors. So these are people that don't necessarily look for outside help, and they kind of have some kind of conviction on the market, right? So whether it's around earnings releases or an FOMC meeting or anything like that, they don't want to deal with the complications of making an options account or dealing with a margin account where you could get liquidated overnight, or if you're not paying attention to what kind of sort of structure or what kind of exposure you've opened up, you could lose in some cases more than what you've put into your brokerage account.
For
So
sure.
the entire idea behind these is, once again, that level of convenience, right? Because you can trade them just like any other stock or ETF. And the best thing is like options, you can't trade those pre-market or after-market. So right now they can only be traded during normal market hours. But what happens around a big event like earnings is they're usually announced after market hours. So the only instruments that you can trade after market are things like the individual stock directly, or you can also trade ETFs. So that's where you get this added convenience of like, okay, Nvidia just announced this. I'm super bullish. I might just want to go buy a 2x or 3x and just hold on for, whether it's a single day. Obviously, the recommendation is that they're not held for more than a single day, but obviously, there's a lot of instances where people hold these for multiple days, weeks, and even months. Um,
Sure.
but I mean, the one or the main responsibility that we have is just to make sure that people properly understand the products, because if I had a dollar for every time we got a question about how come Tesla's up, let's say 10% over the past 2 weeks, why am I not up 30%? I would be, I don't know,
The K, right?
Yeah.
yeah, exactly, exactly. So
Education's a big aspect.
exactly, exactly. So you really have to look at the path of what that underlying is doing, right? Because over a single day, the math is
Mhm.
very simple. Tesla's up 1%, I'm up 3%. But if you hold over a longer period, then that's sort of, that oscillation around the mean sort of means that if it went up more than it went down, you probably made money, but there's no direct link between what the underlying did cumulatively
Yeah.
and what the leveraged ETF did. So that's why, it's one of those concepts where people don't really understand it until they've traded it, because it's only when you have skin in the game that you actually look under the hood in terms of how does this product exactly work and why is it not matching my expectations, for example.
For
But what
sure.
I can say is that today people are, I would say, leaps and bounds more sophisticated than they were, let's say, 3 or 4 years ago, because they're educating themselves day in and day out about all of these new things that are at their disposal, right? Because whether it's leverage ETFs, whether it's options, futures, or all types of option structures that you can do yourself with on Robinhood or other platforms, people always want to learn something new, right? So oftentimes they're actually learning faster than the institutions in places like Twitter and Reddit. And you'd be surprised, like the kind of sophisticated questions we get from people.
Yeah, that's pretty cool. And to your point, obviously, education is the key for managing those expectations. What's like the mechanism for balancing of these ETFs or ETPs? How do regarding the embedded financing, those aspects of kind of how you explain that to investors?
Of course. So that's also one of the concepts that kind of like
Yeah.
confuses people, is like, how do I get 3 times the return and I'm just like buying one share of
Right.
this fund? So behind the fund, there's obviously some more sophisticated things going on to give you that exposure within the ETF. So the way that we structure our products is what we called with physical replication. So a lot of companies use things like swaps, where they work with a big bank, and the big bank basically agrees to provide, let's say, a multiple of the return of the underlying in exchange for some kind of fee. So that kind of return is ultimately guaranteed by the swap counterparty, as it's called. But with
Mhm.
us, it's a little bit more straightforward, because we do it through what's called margin borrowing. So let's say we have $10 million of money that comes into triple lever Tesla. We would take that money, buy actual shares of Tesla, and using those shares as collateral, we use margin borrowing to buy another 2x on top. So what happens is you have essentially 3-to-1 ratio in terms of how much collateral you have versus what's in the ETF. So that's how we're able to structure it for these for the leveraged ETFs that we offer. And apart from the leverage stuff, I know the name is still leverage shares, but nowadays we're actually slightly more popular in Europe for what we like to call income
Mhm.
shares. So this is basically a sub brand that we launched of leverage shares, and this is where we focus a little bit more. It's still around individual stocks for the most part, but it's not all about growth. It's more about using the volatility of those underlyings to get monthly yields and to be able to pay out monthly distributions. So it's a massively growing category in the U.S., and we're kind of sort of seeing that same story start to play out in Europe.
Yeah, yeah, that's really interesting. I guess from that point of view, there's still these types of products are listed on various exchanges globally.
Yeah, yeah. So the other thing that I should mention is we have a sister company in the US, so that's called Themes ETFs. So they have thematic ETFs and they also do 2x single stock ETFs. That's in the States. But what I'm directly focused on is the European business. And here, there's a lot of things that maybe US based investors might not be aware of. Just because in Europe, you have so many different
Yeah.
languages, you have these different tax
Right.
treatments, and you have different currencies. So there's a bunch of fragmentation. So the user experience from, let's say, an Italian is very different from, let's say, somebody based in the UK. They don't use the same brokers. Like there's a few amount of brokers that are sort of big across the continent. And the other thing is you have different currencies. So when I'm buying an ETF, I don't always have to buy it in US dollars. So let's say I want it to be denominated in euros, I can buy the same product denominated in another currency. So you have these like share
Mm.
classes of ETFs as well, uh, which has been, I think part of the ETF scene for as far as I know. But I do think that we're still about 5 years behind the US just in terms of like cohesion. Things like payment for order flow and things like that. That's a concept that exists in certain countries, for example, in Europe, and it's banned
Mm.
in others. And things like rebates, where sort of the advisor gets a kickback for investing in certain ETFs. That's illegal in many jurisdictions, but in Europe, it's actually
Huh.
legal in multiple.
Do people have to pay for trades in Europe?
So there are new neo brokers that are popping up nowadays, sort of like the
Mm.
Robinhood model.
Yeah, yeah.
But the uptake for them has been, I would say, relatively slow at the beginning. It's starting to pick up now, but for many platforms, you still pay a pretty big fee for trading. So I know like some of the biggest
Yeah.
platforms, like for a single trade, you still have to pay like 8 to 10 euros per transaction. So that really adds
Wow,
up if you're
Yeah.
trading small sizes. Yeah,
for sure.
yeah.
Where have you guys seen the most traction in terms of like leverage? So,
Mhm.
there's the 2x, there's 3x. I saw you guys have 5x, which is
Yeah.
sick. Where's most of the flows coming?
So when we first launched the products, it was 12 names and it was on what I call boring companies. So we had like Walmart and we had like
Hmm.
Nike in there and nobody was trading these products. And we were like, okay, maybe like the concept is not going to work out. But then we were like, okay, if you think from the perspective of an actual active trader or a day trader, nobody's trading those names on an intraday basis, right? They want the volatile
Got
names.
the Teslas, the
Yeah.
Nvidias.
Exactly. So we did is we increased the leverage factor because I think there's like a sweet spot as well. Because if you, in Europe we can even do higher leverage, right? We can probably do like 7x Tesla, but at the end of the day, it's very difficult to make money because that decay is gonna it's gonna eat away your gains very quickly, right? So we thought 3x was sort of like the sweet spot where we kind of met that demand, and there was also another element of picking the right underlyings, right? So it was the big tech names, it was the Nvidias, the Teslas, the Palantirs, the MicroStrategies of the world. Because one other thing that is a thing in Europe is everybody knows their own, let's say, domestic names. So French people know the
Mm.
French names and British people know the British companies. But apart from that, everybody knows the big US tech companies and everybody pays attention to what's happening in the US stock market. So once we started launching those more volatile names with slightly higher leverage, that's when things really started to pick up. So we have, I would say the most popular ones right now are triple levered Tesla, then it's Nvidia. I think MicroStrategy is in the top five.
Mm.
Coinbase, triple levered
Yep.
is up there. And then we have a 5x NASDAQ product. That's, I think, among the top five as well. And we even have a 5x Magnificent Seven product. So it's a basket of those seven names with 5x leverage on top. And we also have inverse versions of almost all of them. So if you're bearish, you can buy the inverse version, which basically replicates going short.
Yeah.
It's you kind of answered what was going to be my next question, but how do you guys go about selecting the stocks in the baskets that you're creating?
It's I would say it's somewhere between an art and a science because it's not something that you can just like do market research on because nobody knows what the next like Tesla or Palantir is going to be, right? Just think about it 2 years ago. Who cared about Palantir? Like nobody. How many
Yeah.
people even knew about the stock? And nowadays, on a daily basis, it's literally one of the most traded stocks in the world. So that's why you kind of have to be a little bit forward looking in that you got to pay attention to the kind of requests that you get via email or social media. You got to pay attention to these different platforms to see what people are interested in, what they're talking about. And based on that, sometimes you're going to launch products that are duds, and then you're going to launch some that are going to, make up for the other 10 or 15 that you lost
Yeah.
money on. It's just part of the game, but yeah, it's very much, I would say, an art compared to a
Yeah,
science.
I guess on just talking about different products that you guys have created and thought about and brought to market, income products being a recent one. Do you guys white
Yeah.
label your ETP infrastructure to third-party issuers?
Yes, we do. That's a really good question. I'm glad you brought it up. So we have over 180 products in Europe. So I think that's almost, I think we have something like 10% of all the ETFs or
Wow.
ETPs that trade in London, for example. So at some point we thought internally, okay, obviously we have this economies of scale for having launched so many products. Why don't we rent out that infrastructure? Because the ETF wrapper is obviously becoming more and more popular. So people who want to enter the ETP game, we make it easier for them. So we have a white label platform where we say, okay, bring us your strategy, whether it's something that already exists in another wrapper like a mutual fund or it's something that's brand new. And we basically do everything in the back end, and you're in control of whatever the strategy is. So we do the listing, we do all of the, we work with a lot of the counterparties that you have to work with, like market makers, with the exchanges, and with the different, other counterparties and, legal documentation, things like that. We basically take care of everything and make sure the company that's launching the product has to only focus on making sure their strategy is working as advertised. So the one thing that we don't promise is distribution, right? Because our view is that nobody understands your strategy better than you. So whether it's like a passive product where it just tracks some kind of vanilla index, or whether it's super active, or it's like some kind of hedge fund strategy where you're doing long short you know some kind of a pairs trade maybe. So the only thing that we don't do is distribution of that strategy, but everything else we take care of that, and we basically say the only thing you have to focus on is this. And I think we probably do it a lot cheaper than anybody else in the market. I think to launch it's something like
Mhm.
50K, and then on an annualized basis it's something similar, which basically means that if you get anywhere between 7 to 10 million in AUM, you're already
Operational
breaking
break
even.
even.
And if you
Yeah.
yeah, and if you compare that to other platforms, usually it would be, at least 5 to 10 times that to
Yeah.
break even.
It's
That's a big
huge.
deal. Yeah. What type of criteria do you look for in a partner? Is there certain elements or requirements as you look to bring products to market from your guys' view?
We've also had a few like learning lessons over
Yeah.
the years, right? Because people like to make promises, and one of the mistakes that a lot of, I would say, money managers make is just because the strategy or the performance is good doesn't mean people are going to invest in your product. So distribution has to be just as good as the strategy. So we usually look for seed capital first, so money that's lined up to be invested right away. So we usually look for a few million to begin with. And depending on how, let's say, complex the strategy is, the terms are obviously very flexible and they always depend on the counterparty. So if it's like there's companies that want to do multiple products, obviously they get a discount. There's people that have simpler strategies. Obviously for us, it's a lot easier to run, so they get a discount. But usually there's some kind of seed capital that we look for, and then we also have sort of these AUM milestones that we agree on mutually to reach. And then obviously if everything goes according to plan, because there is a fee split model, then the good thing is there's no conflicts of interest, right? It's in everyone's interest for that product to grow, because obviously the more revenues there are, the more revenue split there is between the company that's launching the product, actually, which is us, and the company that we're launching it
Yeah.
for.
No, that
So
makes a lot of sense. I know that the similar kind of path in the U.S. some people have is a shared or series trust model with ETFs, where you can kind of just plug into their existing board and all that, which sounds like it's a similar product um, positioning on your
absolutely.
sense.
And just in terms of criteria, I don't think I answered that part. I mean, the main thing is for the underlyings to be liquid. That's the biggest
Got it.
criteria. I mean, if you want to invest in small cap, let's say Taiwanese stocks, that makes it very difficult, right? Because it's hard to access them. You have that currency risk. The market makers aren't happy pricing those. So there's a lot of complications. But if it's, let's say, bigger US stocks, not very active trading, then there's almost nothing we can't do. So we can trade commodities, we can trade ETFs, we can trade stocks, we can trade bonds, we can trade structured products. So we almost have no limitation as long as the underlyings are liquid
Yeah,
enough.
makes sense. Just curious from you mentioned distribution earlier. What does that
Mhm.
landscape look like in Europe um, from your view? Placement
It's
agents, just various counterparty parties that are working through that.
Yeah, it's honestly it's very hard to navigate because in Europe every market is very different, right? So, like I mentioned earlier, if you're in Italy, for example, they still have that rebate model where a lot of the money managers they're looking to be incentivized for investing in your product. Whereas in other countries, that's illegal, obviously. So, in order to compete, you just have to have a better product. So, it could be tracking, let's say, a better benchmark or just being outright cheaper. So it's a matter of having the right people in each market that basically know the landscape. And then in other places, it's a matter of just chasing all of the brokers to make sure your product is available for trading. Because I think in the US, a lot of investors are spoiled for this. But as soon as a product, is IPO'd or is launched, it's automatically on Schwab, on Robinhood, et cetera. You can trade it
Yeah,
from day one. That is not the case in Europe. We almost have to like, not, I don't want to say beg, but we have to keep reminding brokers like, hey, there's interest in this product, add it to your platform. It's going to
yeah,
be traded. And then you have this chicken and egg problem where they're like, okay, if we get demand, then we'll add it. But then we're like, how's there going to be demand if the product's not available? Like, how can we prove that there's demand? So it's
Right.
just like these mind games back and forth. But it's just one of those things that you have to be aware of if you want to enter like the European landscape. Because I think one of the quotes that I keep getting reminded of is Kathy Wood because she finally entered Europe, I think, a few years ago, and the uptake even in her ARC products was obviously in the US it skyrocketed, but when she entered Europe I think she got to 100 million in AUM like after 2
wow,
years. And she literally called Europe the most complex ETF market in the world exactly because of the reasons that we're talking about.
very interesting.
It's just really fragmented, right?
Yeah,
Just
So fragmented.
all these different countries, different exchanges, brokers.
Unbelievable, and it's very frustrating for everybody involved. But the good thing is that I guess we've kind of built a moat because over the years, because we faced all those complications, we kind of know how to approach each of those individually. So that's
Yeah.
the silver lining, I guess.
that's awesome. What's we talked about a lot of different types of products that you guys have brought to market. Anything in your roadmap that you're looking at to build at this point? I probably see a lot of different trends with people coming to you asking about these products or those types of products. I'm just curious.
Yeah, yeah, of course. That's a really good question. So in Europe, I think I don't want to say we've saturated the market, but I feel like any other leverage product that we add, I think it's like diminishing returns from here on out because we already have all the popular names and anything like the new quantum names or AI names that are popular now, those tend to sort of fizzle out over time. We tried a few like Zoom and Roku in the past, which were like COVID
Mhm.
darlings. They were popular
Yeah.
for like a few months and then they sort of died out. So I'm not too bullish on like the leverage single stock names moving forward, just because I think we've covered most of them. But this entire like income or monthly income idea, I think is just fascinating because in the US, if you look at companies like Yield Max or Round Hill or any other names that have like brought this concept to the market, I think about 2 years ago, where you just use the volatility of a single stock or like a small basket of stocks. And then instead of trying to capture that full growth, you are just selling options to be able to capture all those premiums. And then those premiums are paid out as dividends. Because when you thought about dividends in the past, it was like, okay, crap, I have to invest in like Procter and Gamble and Coca-Cola, and I have to invest like hundreds of thousands of dollars to get paid once a quarter. And the yield on that is going to be like 2% on an annual basis, or maybe 5% in like one of the
Yeah,
higher versions. So it's like this new concept of trading options on an individual stock, and then all of a sudden you get yields north of 50%, sometimes even 100%. Is like it's a wild concept, and there's like almost this cult like following in the US for these kinds of products. And we saw that nobody was doing it in Europe. And for me, it was absolutely mind blowing. I was like, why isn't anybody doing it? So we launched those sort of competitors in Europe last year with a few. I think we started with three, and now we have 19. And probably by the end of the year, I think we're going to be close to 40, if
wow.
not more. And it's going to be
Are these similar like to the single stock ETFs where you're just getting these single option premiums for Tesla or for, Nasdaq, or is it,
so the
I don't know, is there like more flexibility where these, market makers go to different assets?
So the user experience is very different, right? Because if I'm buying the leverage stuff, I just want the price to go higher and higher. That's all I'm
Right.
interested in. So if I
Yeah.
invested 100 at the end of the month, I want that invested amount to be at 200, for example. With the options income products, it's not necessarily the same mindset. It's more like people looking for a passive stream of income. They're like, okay, I'm bullish on Tesla, but I don't necessarily care if I double my investment over the next 2 months. I want my invested amount to be stable, and in the meantime, I want to get dividends every single month. So if I've invested $100 in Tesla, by the end of the year, I want to keep that base of $100 that stays invested, and hopefully I'll get, let's say, $50 in dividends on top. So the total return would be the 100 plus the 50 on top. So they don't necessarily get the full return of maybe the underlying stock, or obviously definitely not the leverage version, but they're okay with that because they're more interested in having that stable monthly income.
I guess maybe a different way to ask the question, like how are you guys thinking about structuring these products? Like,
Mhm.
you're obviously we're with these products we're selling option premiums to collect that
Exactly.
kind of
Yeah.
recurring revenue. Are you guys looking at that more like, hey, we're going to sell the options for NASDAQ, or we're going to sell the options just for Tesla in this particular product?
Exactly.
Or is it more like global?
No, that's exactly how it works. So for each of the ETPs, especially the ones around single stocks, so let's take the Tesla one for example. What we do is we actually buy Tesla stock. So we keep a portion of the entire portfolio unkept, where we just hold Tesla stock. And then we have about 75% what's called a coverage ratio. So that's the portion of the portfolio that we write options on. So you can do this in basically two ways. You can do what are called covered calls, which is like you have the stock and you just sell call options a little bit out of the money. Or you can do what's called put rights. So instead of selling call options, you sell put options. So there's there's a few details in put options that kind of make a little bit more sense if you have a bullish bias on a lot of the underlyings, which we tend to have. So if you look at the performance of, let's say, our offering on Tesla or versus the offering of, let's say, YieldMax on Tesla, what you'll see is that in different environments, in many cases, ours will outperform, whereas obviously there's going to be cases where theirs outperform as well. But there's just so many different ways where you can do this. But for us, because we're actively managing it, because we're rolling positions weekly, if not, a few days into the week, we do what's called put rights, and that tends to work quite well, especially if the market tends to tick higher, on a relative, let's say,
Yeah.
consistent
Yeah,
basis.
makes sense.
So yeah, I mean, we started out once again with the single stocks, but then we did Nasdaq, we did S&P, we have a product on gold, which is really interesting, right? Because when you think about gold, it usually does nothing,
Right.
right? It's supposed to be a hedge when things go really really bad. But then if you look at it over the last few years, it's almost
Oh yeah.
outperformed the big indices. So
That's
it's
right now.
crazy. Um, exactly. I mean, it's been crazy. I think it's up more than 50% year to date. And people love to invest in gold, usually as a hedge, but now they're thinking about it as like a core holding. But the thing that gold doesn't do is it doesn't pay dividends. So you can do the same kind of concept around gold, which is what we did. So we bought a gold ETF and then you write options on that gold ETF. So you're still getting the price exposure to gold, but in the meantime, you're getting some dividends on
That's
top of that as
interesting.
well. Obviously, it's going to be very far from the numbers you get from Tesla, but you still get some cash
Get
back.
something. Yeah, that's great.
Yeah.
Yeah.
Yeah, I mean, moving forward, it's all going to be about, as a company, you have to know. I don't want to say you want to stay in your lane, but you got to know what your advantages are, because we're never going to compete with like a plain vanilla S&P 500 product because iShares exists or Vanguard exists, right? So we got to pick these corners where we have the advantage just because we're known for making the more sophisticated products, and just take advantage of that and try to introduce new concepts that people might like to see within sort of this ETF
Yeah.
market.
Well, to your
Yeah.
point too, as well, Octay, obviously for the average user or folks who don't want to do puts or options, call options, or they don't want to have a margin account,
Yeah,
they can just go straight to you
absolutely.
guys.
I mean, absolutely. If you have to open up your account every single day and know exactly when to roll, and people don't have these like psychological barriers, right? So we're emotional investors, like
Yeah.
all of us are. So if we have access to all of our money and all of our investments 24/7, I guarantee you we're going to make more bad
All
decisions than
right.
good ones. So that's why, having someone else sort of manage the more complex part of the portfolio, I tend to think it's almost always a good idea.
Yeah. Well, Octay, this is great. You answer most of my questions before we even ask them. So this has been a lot of fun. Really cool to learn about just leverage shares and the company you guys are running. Where could people go to connect with you and learn more about leverage shares?
Absolutely. So if you want to connect with me, I'm super active on social media. So you can find me first name, last name on LinkedIn, or O Kavrak on Twitter. And if you want to find out more about the company, just drop us an email, info@leverage.shares.com, or just follow us on X, on LinkedIn. I think we're even active on Instagram. So I think it's not very difficult to find us.
Amazing. Well, Octay, this has been a fun conversation. As Mike has mentioned, we'll make sure you call all your contact information in the show notes. And thanks for joining us today.